It's about time that we take the focus on to the editor's cut. And Alex, what do we have today?
It's going to be a power-packed segment, I think, Niraj. So let me very quickly set it up so that my colleagues can knock it out of the park. The first one has to be about the banking pack. You've seen earnings from all of the private sector banks in. And in fact, it can be said that this entire sell-off for the last 5 sessions or so has been led by the banking pack. HDFC Bank first, but that became more broad-based. The reasons why are what we're talking about at the start, and whether or not this is a problem primarily with HDFC Bank, or is it something that you can see in the signs of the earnings across the board as well. The second aspect is the delivery stats, because this is going to give you a perspective on how people are trading the stock as well. Yesterday's picture, of course, HDFC Bank delivery has been high, but what is the picture with the rest of the banks? And finally, we'll also talk about oil and gas. There was a sharp crack in quite a few of these stocks, particularly the not the city gas distributors, but for the oil companies, GAIL as well as ONGC. There was a crack. The question is, where do we go from here? Where do valuations stand at right now? And what are the key triggers? Hopefully, I've set it up well. Let's start, Vishy, with you. You've looked at the key numbers. Is it a trend across the board? What's playing out?
So a lot of it is playing out in the large private banking space at this point in time. What is happening is your HDFC Bank, Axis, ICICI, Kotak, IndusInd, all these big banks have come out with their numbers. What is coming out in the commentary is that people are not really excited with what they're hearing from the management. Essentially, the guidance that these private bank leaders are giving, it's not really adding much value in terms of future growth, the expectations for future growth. One thing that is specifically interesting in this cycle is that the better asset quality, that edge that the private banks had, that seems to be going away, because your public sector banks have already caught up with most of the asset quality gap that they had, the private banks. So that has been priced in. So what's left? Well, growth, and that growth is not looking so great. So if you look at where banks, large banks are guiding their credit for the year, most of the large banks have pointed out that eventually your deposit growth and advances growth are going to converge.
Yes.
What does that mean? Convergence, either your deposit growth picks up materially or your advances growth comes down. For deposit growth already in the system is at close to 18% year on year for these large banks. That's about 600 bips higher than where the rest of the system, 500 to 600 basis points higher than the rest of the system is. So room for it to go up further seems very limited. So the only other alternative is that credit growth starts coming down and starts matching where deposit growth is, because you have to maintain that credit deposit ratio. The regulator seems to be uncomfortable with the way it's panning out in the system. And of course, that leads to unnecessary increase in cost of funds. So that's where the advances growth side is. The other thing is that margins are looking like they're going to compress for longer than previously expected. The expectation was that by the first quarter of FY25, you will see some sort of stabilization. In fact, some better banks may see improvement. That doesn't seem likely, because if the deposit repricing is still pending, then your margin compression is going to last longer. And the last bit is on the OPEX side. So there, again, a lot of banks are talking about branch network. They want to increase the footprint. Does that necessarily lead to better deposit growth or better business growth? The jury's still out there, because till last year, everybody was talking about how amazing digital is and that's going to push up business. Now they're back to the physical branch model. It's not clear whether the trade-off of higher expenses for the short term and then maybe better business later is going to play out yet. The expectation is that at least till September of 2024, you're going to see elevated expenses for major private banks.
Two questions on the asset quality. There's that one provision number for AIFs that stood across the board, apart, barring one, I think.
Yeah, so actually the one that had the highest number on AIFs, which was ICICI Bank, is luckily the only one that did not see that big of a sell-off, because it sort of performed better than the others. Most other banks are reporting 150 to 200 crore between that in terms of provisions. ICICI Bank did not see any of that. They reported a 620 crore number, which was significantly higher. What these private banks are, however, saying is that none of this is because the assets are bad. This is because the regulation have changed, so we have to provide for it. But it's unlikely that we are going to actually report losses on those provisions. So eventually, as they unwind those investments, that money comes back to the profit.
Okay, and the last from my side, I'm sure that gentlemen have more to add, but the last from my side has to do with the capital adequacy. We saw Axis come off very substantially.
Yes.
Of course, that has to do with risk weights. Does that mean that banks will have to raise in the next couple of quarters?
So far the commentary has been that we do not need more capital. We are still above the regulatory minimum. So, and of course, that is also feeding into the fear that growth may not be so sharp, because if you don't need to raise capital, obviously your growth is going to come up.
Which is an important point.
Yeah.
Let's talk about delivery. And anything to add? Yeah, okay, so let's talk about delivery, and that has stood out as very high over the course of the last few trading sessions.
Sure.
What was yesterday's number?
So I'll start off with the Bank Nifty, which has corrected about 7.5% from the top, from its lifetime highs. And in this same period, we have seen a correction largely on account of HDFC Bank. 7.5% is not a very large number. At 10% even, it's not a technical bear market. It comes in at around 20%. That said, at 10%, there will be a lot more caution as far as the banking index is concerned. On account of HDFC, we've seen a 15% correction from its earnings. About 30,000 crores of delivery-based buying in HDFC Bank since the day it came out with its earnings, including 5,500 crores worth of selling, delivery-based selling yesterday. So it is substantial. That's nearly $3.5 billion. And just if, this is a very rough way of comparing, but since over the past 5 days, FII selling has been worth around 28,000 crores.
Correct.
Of course, this is not a like-to-like comparison, because in HDFC you don't just have FII sellers. We also have domestic institutions and retail participation as well. That said, in terms of the numbers yesterday, we are looking at substantially higher delivery numbers for all the banks. So HDFC consistently at 65% delivery number coming through, but even for something like an ICICI Bank, of course, that was the only private sector bank which advanced. But say for that, we had about anywhere between 55 to 65% delivery numbers coming in yesterday as well, which means that should we see more selling coming through, there's a likelihood that the Bank Nifty, not immediately, but over the span of the next few weeks, could correct as much as 10% from the top.
Understood. Niraj, you want to add anything to that, or you want to jump straight to the...
No, this is comprehensive enough.
It's
so
comprehensive.
let's move on to oil
Let's
and gas.
talk about oil and gas. And
Yeah.
I think the basic question is, where do we go from here, and what are the key triggers?
Answer is who knows. But, but be that as it may, we just thought we'll take a look at the valuations a little bit, right? So the cue also came from the fact that yesterday there was this LNG deal signed between Qatar and India, and Petronet and some of the others did very well. Could OMCs and some of the others follow suit? Because city gas distributors have done well. I'll come to them at the end. I'll start off with ONGC and Oil India, the upstream players. Now, the valuations currently FY25 basis, 0.8 to 1. Actually, Oil India is slightly cheaper than ONGC, but 0.8 to 1 times 1. FY25 expected price to book. We moved to FY25. Everybody's, actually some people are FY26 also, but let's avoid that. FY25, right? This is about 20 to 40 odd % below mean, depending on what's the time period that you take, and depending on what estimates do you take, people assign to these stocks per se generally, and they are trading at an attractive dividend yield of about 6%. Now, under any market, no matter how strong it is, 6% dividend yield is somewhere where PSUs see buying. This traditionally used to be the sweet spot for REC PSU, as you guys would remember. 6% dividend yield, okay, people would say, hey, this is great. So ONGC, All India are now trading there. And unlike the OMCs, which have this hangover of marketing margin-led gains, but whatever if the price cuts that come in, upstream doesn't have that problem. Sure, in the past they've been saddled with putting in some money where the government might need it, but let's leave that aside for now. So the valuations, the dividend yield, etc., not too bad. Therefore, could they see a bounce back? Maybe. The other one is GAIL. You know, Petronet and some of the others have rallied because of this drop in LNG prices. GAIL hasn't. GAIL is a beneficiary out there too. So you just compare what GAIL has done versus what some of the others have done. GAIL has hardly had a move. Now, also in terms of valuations, at the question that I ask is for GAIL, at FY25 of what, 12 or FY26, 10p, is GAIL really expensive? And if not, what is ailing GAIL? You know, that's the question that comes to mind. Not too much. The recent performance has been pretty decent. This cut in LNG prices could help GAIL. So that's the other one to focus on. City gas distributors, MGL today, the results, as all of us have seen, would probably work for the stock, right, today. But the larger point is that lower LNG prices at large augur very well for some of these businesses. And LNG prices have come off about 40-45%. The back of the envelope calculations that brokerages have done is that a 50% drop in LNG prices would mean nearly a 25 to 30% expansion in earnings for these companies. Have we seen that kind of a price rise? We haven't. Yeah. So could we see that? Who knows? But the market is in a corrective move, so it's stupid to make a bullish argument right now. But there is an argument to be made here. And lastly, Petronet. I mean, yesterday, it's a beneficiary of lower spot LNG prices. And yesterday there's this deal signed, the stock was up 5%. Could it do more? Maybe. Could allied places like Aegis Logistics, for example, do more because they are large in LNG terminals? So, all of those come into play, primarily because the stocks didn't rally too much and there has been a bit of a correction.
Fantastic.
Just a quick note on an S&P Global note which came out recently in the last 4-5 days. And they were talking about capacities for upstream oil companies. And they have mentioned that while they have promised a certain capacity, S&P Global believes that those capacities will not be fully on stream at least this year, which means there could in fact be a supply constraint, and that could in fact also lead to higher prices as far as their products are concerned, which eventually could land up benefiting these companies themselves. So that's another point to perhaps ponder upon.
Yeah,
clearly.
Certainly.